Hello everyone. Today we are dealing with life cycle costing and we will take up some examples related with life cycle costing. This is not a full lecture and we are just looking at the important points or the key points related with life cycle costing. Let's look at our learning objective for this session. So we would be first looking at what exactly is life cycle costing and how cost is calculated based upon life cycle costing, and we're going to also differentiate it from the way cost is being calculated under traditional cost accounting. We would also look at that how life cycle costing can be a very effective tool in setting prices, particularly in strategic prices. And lastly, we're going to look at the interrelationship between the target costing, which we did in the last session. And we are trying to build a relationship between target costing, life cycle costing, and a kaizen, which are all three wonderful tools of cost management. Now, before we go ahead, let's look at how costs are being calculated traditionally. So if I ask you what is the cost of a product, what would you do under your traditional cost accounting? You will take out the manufacturing cost. And when you say manufacturing cost, it includes direct material, direct labor, manufacturing overheads. All these three things together, you divide by number of units, and then you have your cost per product ready. Now, this cost which you are talking, this cost is calculated for a short period. And when I say short period, generally it means over a period of a year, or it could be shorter or a longer, but normally it is considered as a year. So once you have calculated your cost, let's look at, do you see any problem here? Right? Let me give you a couple of examples so that if you can figure out some issues with the way the costing has been done. There is a pharmaceutical company, and this pharmaceutical company has been trying for 5 years with a very great effort in terms of research and development to develop a drug. And the drug was finally developed and manufactured. Okay, so when the drug was manufactured, the drug cost, the cost of manufacturing includes only direct material, direct labor, overheads, but there is no mention of research and development. Okay, take another example. Let's say there is a car manufacturing company, and the car manufacturing company has sold some cars, but those cars have some inherent defect or some manufacturing defect. Now, because of the manufacturing defect, there are a lot of customer complaints and there is a lot of warranty claims. Okay, and then also company has to pay huge time and effort and money in terms of after sale service. Now, my question to you is, what you're going to do with the after sale cost? What you're going to do with the warranty cost? Okay, you will say, what is the big deal about this cost? Let us put it as a period cost. That is exactly we have been doing, right? But the issue comes when you are ignoring the cost which is you have incurred on research and development, or you are ignoring the cost which is after the sale of the product. you are having a very narrow view of the cost of the product. So, what is the solution? We can look at life cycle costing. So when we say life cycle costing, there are three important things before we go ahead with what exactly is life cycle costing. So in life cycle costing, we are looking at the cost from a very, very different perspective. We are looking the cost not only from manufacturing angle, but we are looking at what is the cost which is pre-manufacturing and also the post-manufacturing. So when I say pre-manufacturing, I'm talking about upstream cost. When I say post-manufacturing, I'm talking about downstream cost. And since the most of the costs are incurred at design stage, it is important for the company to consider that what is being done in the design stage. To put everything together, life cycle cost is simply a sum of all cost which has been incurred right from the conception and fabrication until the end of the life. Here you have cost life cycle of the product. Now in cost accounting, we have been focused on only this manufacturing. This was our main focus area, and all the cost of the product includes only manufacturing cost, because research and development, design, marketing and all other expenses, they go as a period cost. They're not a part of cost of the product. Whereas in case of life cycle costing, this is the main difference between your traditional system and what we are doing in life cycle costing. We are including all cost. And when I say all cost, any expenses you have incurred on research and development, design, particularly for pharmaceutical companies, electronic companies, or the companies which are highly into IT and digital services, the research and development cost is one of the important costs which need to be considered. And also the cost which you are incurring in marketing and distribution, customer service, or any other end of the life cost. So all the cost which has to be incurred right from the inception to the end of the life of the cost of the product are all included in life cycle costing. Let's look at an example of how the life cycle costing is calculated. So in this case, we have given a product with a life cycle of 4 years, and company gave us all the information related with upstream, manufacturing and downstream cost. And company says that they are producing 400,000 units, and the selling price is going to be based on 125%. That means 25% is the markup on the cost of the product, and the cost is calculated based on life cycle costing, and we are required to calculate the selling price per unit. So for calculating the cost, it is simple. We include all these costs together, upstream, downstream and manufacturing cost. So we got the life cycle cost, and we got the selling price by including 25% markup on the cost, and selling price comes as 14 million. The total selling price for 400,000 units is 14 million. For calculating per unit, we're going to divide with number of units, and we got the selling price per unit, which is £35. So now you have seen in the numerical that we are including the entire life cycle into the costing, which includes your development, your manufacturing and the phase out cycle. So when you talk about life cycle costing, basically you are looking at a very longer term perspective rather than a shorter term perspective of 1 year as we do in traditional cost accounting system. And we have a better picture about the cost of the product, because you are not considering only a small portion of the life cycle, which is the manufacturing cost, but you are looking at what goes before and what goes after the manufacturing cost. Just to sum up the differences between life cycle costing and traditional cost accounting. So life cycle costing, you do the costing of a product right from the inception to abandonment. You look at the true profitability of the product over its life cycle. You include all cost, pre, post, upstream, downstream, all cost. Whereas you don't do these things in your traditional cost accounting. After understanding life cycle costing, we'll try and relate life cycle costing and target costing. So here is a target costing and life cycle costing for a new product. So this is a new product. You can see that we start with target pricing and then we deduct your target profit. We have our target cost. Okay. So once we have our target cost, what we do, we look at value engineering aspect. We look at what is the cost existing as a now, and then we compare our costing as a now with the target cost. Okay, so if we are we are able to match with the target cost is the maximum allowable cost. We cannot go beyond that cost. So if we are able to match with the target cost, let's say the target cost is 50,000 and our cost calculations for the product comes as 45,000, we are ready to go and we can go ahead with your life cycle cost. But in case we are not matching, we still have to go back to the value engineering or the design stage, where we have to redesign the product and we have to keep on applying re-engineering, value engineering and redesigning till the time we are able to meet the target cost. And once we have met the target cost, we look at the life cycle cost, right? So we look at that, are the life cycle cost acceptable? If the life cycle costs are acceptable, that means your research and development, manufacturing and post-manufacturing, all this cost is, and these are only committed costs. Please remember, there is no production started as of now. These are all calculations before the start of the production. If it is not acceptable, we go back to again redesigning, again doing the value engineering process, looking at the features and how best we can maintain the features while cutting down on the cost. And once we are happy with the life cycle cost and we are happy with our target cost, then we go ahead with the production, right? Then the production starts and then all the costing and the manufacturing cost are incurred. So this is a stage where the costs are actually incurred, the manufacturing costs are actually incurred. Before that, it is just a commitment. So when I say commitment, you have decided about the cost, but you haven't incurred the cost, because cost is actually incurred when you start manufacturing the product. Okay, so when you are manufacturing the product, then you do your kaizen costing. Kaizen costing means you look at the process or the production development in a way that you go for lean manufacturing, you go for upgradation of your manufacturing system, so that gradually or step by step or a continuous improvement can be done. And then at the end, you look at your end of product, which includes your decommissioning or any disposal cost which you have to charge. So adding to your list of strategic pricing areas, we have looked how full cost plus markup, which is cost plus markup approach in the last session. We have looked into target pricing approach, and we have also looked into how the pricing can be done based upon your life cycle cost. Just a quick recap, that if you have your manufacturing cost, you have end of life cycle cost over here in this example, then the total life cycle cost is manufacturing cost plus end of the life cycle, which in this case becomes 175 pound. The company uses a markup based upon life cycle cost, and the selling price based upon the life cycle cost comes as 218.75 pound. These were the important points which you have to consider regarding your life cycle costing. But if you still have any questions or any doubts, please email me anytime. Thank you very much.